Accounting is more than just numbers, it's the story of human endeavour. From the earliest bartering to today's complex global economy, we've needed ways to track our transactions. Imagine a time before writing, when knowledge lived in memory. As our societies grew, so did the need to keep records. This is the story of how accounting evolved, driven by our inventions and the increasing complexity of our commerce. We began with simple marks on clay, evolved to elegant systems on paper, and have now entered the digital age. Each step reflects not just our ingenuity, but also the growing scale of our economic interactions. From the clay tablets of Mesopotamia to the cloud computing of today, one thing remains constant: the need to understand where our resources come from and where they go. Join me as we explore this fascinating journey through the history of accounting. The video is for educational and entertainment purposes only. It is not financial advice. Do your own research and do not invest more than what you can afford to lose. Our journey begins in ancient Mesopotamia, the cradle of civilization nestled between the Tigris and Euphrates rivers. This fertile region, often referred to as the land between rivers, was home to some of the earliest human settlements and innovations that shaped the course of history. Here, over 5,000 years ago, the Sumerians developed a writing system called cuneiform. This system, composed of wedge-shaped marks on clay tablets, represented one of humanity's first steps towards written communication. They used it to record everything from laws and literature to, crucially for our story, business transactions. These records were essential for maintaining the complex economic activities of their society. These early records were more than just receipts. They were a testament to the Sumerians' advanced understanding of administration and governance. The Sumerians used clay tablets to meticulously track the flow of goods from agricultural harvests to temple offerings. This detailed record-keeping was vital for managing their resources efficiently. These records helped them manage resources, allocate labour, and even measure the wealth of their city-states. By keeping track of every transaction, they could ensure that their society ran smoothly and that resources were distributed fairly. These scribes, the ancestors of today's accountants, developed systems of measurement, documented transactions, and even conducted audits. Their work was crucial in maintaining the economic stability of their society. They laid the very foundation of accounting, demonstrating an early human urge to bring order and accountability to the exchange of goods and services. Their meticulous records allowed for transparency and trust in economic dealings. The techniques developed in Mesopotamia spread throughout the ancient world. As trade routes expanded, so did the influence of Mesopotamian accounting practices. From Egypt to Greece to Rome, civilizations adapted and refined these practices, demonstrating the enduring importance of financial record-keeping. These ancient methods laid the groundwork for the sophisticated accounting systems we use today, highlighting the timeless need for accurate and reliable financial information. For centuries, single-entry bookkeeping, like that used in ancient Mesopotamia, sufficed. But as trade routes expanded and economies became more sophisticated, a more robust system was needed. Enter double-entry bookkeeping, a revolutionary concept that emerged in 13th century Italy. This innovation, attributed to mathematician Luca Pacioli, introduced the idea that every transaction has two sides, a debit and a credit. This seemingly simple concept had profound implications. It allowed for the tracking of not just what was spent or earned, but also where it came from and went. Double-entry bookkeeping provided a more complete and accurate picture of an organization's financial health. It revolutionized accounting, making it possible to track assets, liabilities, and equity, forming the bedrock of the accounting systems we use today. This method spread rapidly throughout Europe, fueled by the printing press and the rise of international trade. Merchants and bankers embraced its power, recognizing its ability to enhance accountability and minimize errors. The company's books, accounting for joint stock ventures. The age of exploration brought new challenges and opportunities for accounting. European powers, eager to fund expeditions and control trade routes, created joint stock companies. These companies were formed to pool resources from multiple investors, allowing them to undertake large-scale ventures that would have been too risky or expensive for any single investor to fund alone. The pooling of resources not only mitigated individual risk, but also amplified the potential for substantial profits. These ventures, precursors to modern corporations, allowed multiple investors to share in both the risks and rewards of exploration and commerce. Investors would buy shares in the company, and their financial stake would entitle them to a portion of the profits, proportional to their investment. This system democratized investment opportunities, making it possible for a broader segment of society to participate in and benefit from global trade. These complex organizations necessitated innovative accounting methods. Traditional bookkeeping practices were no longer sufficient to handle the intricate financial transactions and diverse ownership structures of joint stock companies. Accountants had to develop new ways to record and track investments, expenses, and revenues accurately. Tracking the ownership interests of numerous shareholders, each with varying levels of investment, demanded more sophisticated record keeping. This included maintaining detailed ledgers that recorded each shareholder's contributions, the issuance of dividends, and the reinvestment of profits. The complexity of these records required a higher level of precision and organization than ever before. Accountants developed new techniques to manage these intricate financial arrangements. They introduced double-entry bookkeeping, which provided a more accurate and reliable method for tracking financial transactions. This system ensured that every financial entry had a corresponding and opposite entry, thereby maintaining the balance of the accounts. They had to account for investments, dividends, and the distribution of profits or losses among shareholders. This required not only meticulous record keeping, but also the ability to analyze financial data and generate reports that could inform business decisions. The role of the accountant became increasingly strategic, as they provided insights that could influence the direction of the company. This marked an important shift towards the specialization of accounting, with individuals and firms dedicated to managing the financial complexities of these new business structures. Specialized accounting firms emerged, offering services tailored to the needs of joint stock companies. These firms played a crucial role in ensuring the financial health and transparency of the companies they served. The rise of joint stock companies spurred the development of financial statements, such as balance sheets and income statements, to provide a clear and concise overview of a company's financial position. These statements became essential tools for investors, allowing them to assess the performance and stability of their investments. The standardization of financial reporting practices also facilitated greater transparency and accountability within the business world. This period witnessed accounting evolving from a tool for individual merchants to a system for managing large, complex organizations. The advancements in accounting practices not only supported the growth of joint stock companies, but also laid the foundation for modern corporate finance. The principles and techniques developed during this era continue to influence accounting practices today, underscoring the enduring legacy of joint stock ventures in the history of business. Rules of the ledger seeking standardized accounting. In this chapter, we delve into the historical journey of accounting practices and the quest for standardization that began in the 19th century. The 19th century brought unprecedented industrial and economic expansion, but with it came new accounting challenges. The rapid growth of industries and the birth of multinational companies created a complex web of financial transactions that needed to be accurately recorded and reported. Businesses grew larger and more complex, operating across national borders. This expansion was not just limited to a single country, but spanned continents, making the financial landscape more intricate and demanding. This interconnectedness highlighted the need for consistent and reliable financial reporting. Without a standardized approach, it became nearly impossible to gauge the true financial health of these sprawling enterprises. The lack of standardized accounting practices led to inconsistencies and made it difficult to compare the financial performance of different companies. Each company had its own way of recording transactions, leading to a chaotic and unreliable financial environment. This lack of transparency hindered investment and economic stability. Investors were wary of putting their money into ventures where financial statements could not be trusted, leading to economic stagnation and crises. The need for a common set of accounting principles became increasingly apparent. Conferences and meetings were held to discuss the best ways to bring about uniformity in accounting practices. This period saw the emergence of professional accounting bodies, such as the Institute of Chartered Accountants in England and Wales, established in 1880. These organisations played a pivotal role in shaping the future of accounting. These organisations aimed to develop standardised accounting principles and ethical guidelines for the profession. They worked tirelessly to create a framework that would be accepted globally, ensuring that financial reports were both accurate and trustworthy. While the journey towards standardisation was gradual, it marked a crucial step in enhancing the credibility and reliability of financial reporting. Each milestone achieved brought the accounting profession closer to a unified set of standards. It paved the way for the development of internationally recognised accounting standards, a process that continues to this day. The efforts of those early pioneers laid the foundation for the robust and transparent financial reporting systems we rely on in the modern world. Special thanks to Wikipedia for providing a structure of knowledge. Thank you for watching our channel. If you found this video helpful, please like, subscribe and hit the notification bell for more insightful content. Stay tuned for our next video.